Welcome to vTalkInsight, Risk Sentiment Daily for December 2, 2025. December is starting with a tense mix of de-risking in equities and crypto, offset by big bets on Fed rate cuts and ongoing AI optimism. Let's unpack how this fragile balance is shaping today's market risk appetite. Across global markets, the dominant tone today is a fragile risk-off bias rather than a clean risk-on rally. Equity futures in the US and Europe are pointing lower after a soft first trading day of December, while recent declines in major indices underline that investors are more inclined to trim exposure than to chase performance. Volatility gauges have nudged up from recent lows, signaling a modest rise in demand for protection, even if we are still far from panic levels. At the same time, this is not an all-out capitulation. Precious and industrial metals like silver and copper are rallying strongly on a mix of supply tightness and expectations of US rate cuts, supporting basic resources stocks even as broader indices weaken. In crypto, however, sharp price falls in Bitcoin, Ether, and related equities are reinforcing the de-risking narrative and acting as a visible pressure point for sentiment. The result is a two-speed market where investors are cutting cyclically sensitive or speculative risk, particularly in digital assets and parts of tech, while rotating into perceived beneficiaries of lower rates and real asset scarcity. Flows and positioning confirm that caution is high. Record allocations to money market funds and growing use of defined outcome and buffer ETFs signal demand for downside protection and income, rather than outright growth risk. Yet there are also traditional contrarian signals flashing. Short-term indicators like volatility futures and options put-call ratios are starting to suggest that pessimism may be stretched enough to support a year-end equity bounce, especially if policy news cooperates. Overall, the balance of evidence points to a nervous but orderly de-risking backdrop, with significant sensitivity to incoming policy and growth headlines. Fragile risk sentiment and de-risking are front and center as markets move deeper into December. Equity futures across the US and Europe are under pressure after recent sell-offs in both developed and Asian markets, reflecting broad discomfort with the macro and policy outlook. Smaller cap indices have been underperforming, and weakness in more cyclical and speculative pockets suggests that investors are cutting beta rather than adding to high-octane exposure. The most visible expression of this de-risking has been in digital assets. Major cryptocurrencies have seen sizable drops, with Bitcoin and Ether both selling off sharply and crypto-exposed equities such as exchanges and trading platforms coming under significant pressure. On top of macro uncertainty, renewed regulatory crackdowns, especially in China, have intensified the move, highlighting how quickly sentiment can swing in sectors where policy and liquidity risks are elevated. This cautious tone is also evident in how investors are allocating capital. Record levels of cash in money market funds point to a pronounced flight to safety, while strong growth in defined outcome ETFs and similar structures shows demand for strategies that cap downside and shape return profiles more explicitly. Even in crypto, basis trades that once generated double-digit yields have become less appealing as spreads compress and regulatory and tax uncertainty cloud the outlook, further discouraging aggressive risk-taking. The key issue for portfolios is that this de-risking appears measured but increasingly asymmetric. With many risk assets coming off strong prior gains, investors are quick to lock in profits when headlines turn negative, while fresh buying often waits on clearer policy and data. That leaves markets vulnerable to downside shocks from policy surprises, earnings disappointments, or further regulatory actions, even as the absence of outright stress in funding markets prevents a full-blown capitulation. AI bubble, valuations and concentration risk are now among the most frequently cited structural worries in equity markets. Valuations across leading AI names and broader tech have moved to levels that many see as stretched, with some observers explicitly describing current conditions as a mini-bubble or bubblet. There is concern that recent AI-driven equity gains have been driven more by wealth effects and narrative than by near-term productivity improvements. This anxiety is amplified by how concentrated the leadership has become. Companies like Nvidia hold dominant market shares in key technologies such as GPUs, and their market capitalizations have grown to represent outsized portions of major indices. Sharp swings in mega-cap tech names over recent weeks underline how quickly market value can be created or destroyed when positioning is crowded and liquidity is uneven. Several classic bubble dynamics are showing up around the AI theme. We are seeing circular financing arrangements, aggressive vendor and customer deals, and a wave of debt issuance to fund data center and infrastructure build-outs, with estimates of over $1 trillion of potential new tech debt over the coming years. If AI-related revenue growth slows or margins compress, there is a risk of a 10 to 15% correction in equity indices that are heavily exposed to this theme, with knock-on effects into credit spreads and broader risk sentiment. There are, however, important counterpoints that limit the straight bubble analogy. Demand for accelerated computing and data center capacity appears structurally strong, with reports of waiting lists and clear use cases across industrials, robotics, science, and digital biology. Investor behavior is also becoming more selective, with capital gravitating toward vertically integrated, cash-generative players and away from pure hype. The tension between these solid fundamentals and elevated valuations is what keeps AI at the top of both the opportunity and risk lists. Policy uncertainty and Fed credibility worries are another major drag on risk sentiment. Market-implied odds for near-term rate cuts have swung dramatically in recent weeks, at times moving from very high to very low probabilities and back again within a short span. This volatility in expectations is widely seen as a sign that forward guidance is no longer anchoring markets, raising questions about how the central bank will react to incoming data. Several factors are feeding these concerns. Despite meaningful disinflation and higher unemployment than before the pandemic, policy rates remain materially above most estimates of neutral, leading some to argue that stance is overly restrictive. At the same time, the Fed has not articulated a clear reaction function, making it hard to understand how much weight it gives to inflation, employment, financial conditions, or political pressure as calls for cuts grow louder. Leadership uncertainty adds another layer. Speculation around the next Fed chair, and the possibility that a new, more dovish leader could be signaled before the current term ends, creates a risk of mixed messages if public comments diverge. Globally, talk of rate hikes in Japan and sticky inflation in Europe underscores that policy paths are diverging, complicating cross-asset pricing and potentially increasing currency and bond market volatility. For risk assets, the combination of aggressive market pricing for cuts and doubts about the underlying justification creates a narrow path. A cut delivered for the wrong reasons, such as political pressure or deteriorating growth, could be interpreted bearishly, while a surprise pause might trigger a short-term sell-off as markets reprice from near-certain easing. Until the policy narrative becomes clearer, risk premia are likely to stay elevated and intraday swings around every data release and policy headline will remain a key feature. On the bullish side, dovish Fed and rate cut expectations remain a powerful support for parts of the market. Futures are assigning very high probabilities to a rate cut at the upcoming meeting, with some measures effectively fully pricing in an immediate move. Beyond that, markets are also building in additional easing over the next couple of years, reflecting a growing belief that the peak rate cycle is behind us. Speculation about a more dovish Fed chair is reinforcing this narrative. Expectations that a candidate perceived as supportive of easier policy could secure confirmation have already coincided with 10-year Treasury yields dipping below 4% at times, and with a softer US dollar against major currencies. Many participants are increasingly comfortable with the idea that yields could drift lower from here, particularly if inflation data continue to edge down. these rate expectations have clear cross-asset implications. Metals such as silver and copper are rallying strongly, supported both by supply constraints and by the prospect of lower real rates, and the broader commodity complex has pushed index levels to their highest since early last year. Emerging markets, and especially those with relatively stronger fiscal positions, are also being viewed more constructively as investors reassess the growth and currency risk balance in a world of potentially lower US yields. That said, this easing trade is increasingly crowded. Inflation is still running above target, and several analysts argue that the current data do not yet justify an immediate cut, especially given anticipated liquidity pressures around year-end. If the Fed chooses to pause, or signals a slower easing path than markets have priced, the dollar could strengthen, yields could back up, and risk assets that have benefited from the dovish narrative may face a period of adjustment. AI-led growth and tech leadership continue to provide one of the clearest medium-term bullish pillars for markets. AI-driven CapEx is reshaping corporate investment plans, with hyperscalers and large tech firms shifting aggressively from traditional CPU-based architectures toward GPU-accelerated computing. This is seen as mission-critical infrastructure, not just spending in pursuit of fashionable chatbots. Within this ecosystem, NVIDIA remains a central player. The company controls the vast majority of the GPU market and is still supply-constrained, which, alongside high margins, points to very strong underlying demand. Its deepening partnership with Synopsys to transform design and simulation workflows is one example of how AI capabilities are moving beyond consumer applications into industrial and engineering verticals. The AI theme is also spreading across capital markets. Demand for tech sector debt remains robust, with large issuance being absorbed despite higher leverage and uncertainty about the exact timing of revenue realization from new infrastructure. At the same time, data center operators and service firms are seeing solid pipelines, with some reports of waiting lists that suggest capacity is being pulled into service as quickly as it can be built. For portfolios, this creates a complex balance. On one side, AI is clearly helping offset broader economic softness and underpins optimistic earnings forecasts into next year. On the other, the same concentration and valuation issues that fuel bubble concerns mean that AI exposure needs to be monitored as both a growth engine and a potential source of volatility if expectations reset. Resilient U.S. consumer and retail dynamics are another important constructive element in the current backdrop. High-frequency data from the holiday period show online retail spending hitting record levels, with Black Friday sales rising meaningfully compared with last year. Categories such as health and beauty and apparel have posted double-digit growth, suggesting that households are still willing to spend on affordable luxuries and personal care even amid cost of living concerns. The picture is not uniformly strong, but it is better than many feared. Once adjusted for inflation, real spending growth looks more modest, and there are signs that higher-income consumers may be driving a disproportionate share of the gains. Some data also point to less compelling discounts and softer online volumes in specific segments, indicating that shoppers are becoming more discerning and tactical in their purchases. Even with these nuances, continued resilience in consumption supports a soft landing narrative for the U.S. economy. Growth forecasts show the U.S. outpacing other major developed regions next year, with domestic demand a key differentiator relative to Europe and Japan. For markets, that underpins earnings expectations for a wide range of consumer-exposed sectors and helps explain why strategists remain broadly constructive on global equities despite the evident near-term fragility in risk sentiment. To sum up, markets are entering December with a cautious, risk-off tilt driven by fragile sentiment, AI valuation concerns, and ongoing policy uncertainty, even as powerful bullish forces persist in the form of expected Fed rate cuts, AI-led growth, and a resilient U.S. consumer. The interplay between these drivers will determine whether de-risking deepens or gives way to a year-end recovery as policy signals and data land over the coming weeks. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.